Hello and welcome, everyone, to this week's Hot Corner Insider Strategy session. I am your host, as always, Steve Straz. I'm the Director of Research here at All Star Charts. This is one of my favorite things to do every week, so thank you all for joining me. My loyal Hot Corner Strategy session viewers. Let's run through this disclosure. Let's jump in, do a little quick macro, and then we got a couple new trade ideas, some old ones. We're going to talk a lot about rotation or what participation should look like in a bull market. So let's do this. First, nothing we discuss here today constitutes any solicitation to buy or sell any security. This is all solely for informational purposes and not to be construed as investment advice. For more on our disclaimer, allstarcharts.com/terms. So checking out the chat. How's it going, everybody? Wavy, how are you? Blind Trader, Curtis, we so hot right now. Chris, Paul, what's up, everybody? Okay, it'll be a good one here today. BXMT, Muddy Waters just put out a short report. Nice. Did Oxy make the hot corner? No, but we'll talk about it. We'll talk about it. Remind me if I don't get to it at the end of the call. So first, talked about this chart last week, guys, right? Where it's easy to look at the leaders or focus on the best stocks in your portfolio or the stocks that everybody's talking about that just keep dragging higher. But the truth of the matter was most stocks peaked and started going sideways on November 14th and really coiled in a rather constructive, very bull market kind of way, high and tight, right? These short-term continuation patterns, the higher, which means how big was the trend coming in, underlying trend. So, big move off the October lows, right? And then tighter, which is just, how you would measure this range. You want a really tight range, like almost like a flatline consolidation. And then you want to see an explosive upside resolution. And that's what we got. So this was, I guess, Friday. Some big candles out there Friday, nice follow through Monday, a little give back yesterday, and then here we are today. Everything's looking good again. So we said when we showed this chart last week, well, if most stocks, and I use the Russell 2000 as I think it's an excellent representation of what most stocks are doing or what most stocks look like. So we posed the question here last week. If most stocks have been correcting for 2 weeks and resolve higher from this little coil or little consolidation, multi-week digestion of the gains off of the late October lows. So if those coils or consolidations are to resolve higher, what are the best stocks doing? Probably not falling, right? How about the ones that didn't really correct? They didn't correct in a sideways fashion. The ones that kept grinding higher. I'm talking about Uber, Coinbase, DraftKings, right? A lot of these tech stocks. It would go to reason that they should be doing just fine in an environment where most stocks are resolving higher. That's exactly what we've seen. We continue to see more and more indexes, more and more sectors, more and more industry groups join the new highs list, more and more individual stocks beneath the surface join the new highs list, a lot of new all-time highs, a lot of new 52-week highs. Right, when you get these completed bases, typically you're looking at new 52-week highs at this point. Right, the line in the sand for a lot of these bases or a lot of these reversal patterns that we talk about so often is the August 2022 high. If you go back and look at those charts, you'll see August 2022, August 2022, right? So if we're resolving higher from a base with a breakout level at the August 2022 highs, it's just math. That's a new 52-week high, right? Okay, what's the bond market telling us lately? Nothing bad, that's for sure. So rates have come off in a pretty significant way. I was looking at my bond market book this morning. US 10s, almost 100 basis points since October, a little over a month. 100 basis points. It's taken off some pressure for these long duration equities, right? Let's talk bond market math real quick. When interest rates fall, sure, that's good for real estate stocks these days. That's good for financials. It's not good for energy. We'll talk more about energy at the end of the call. It's good for financials, good for real estate, but it's really good for long duration equities always, right? Because when you take cash flows from the future and discount them back to a present value, today's value, higher interest rates make those future cash flows far less valuable in today's terms. When interest rates fall, those very same cash flows that are discounted back have a higher present value today. And that's how stocks are valued. Go to any of these institutions, these buy-side firms, a bunch of math majors, physics majors, doing DCF models and valuing the different equity instruments that they're buying and selling. That's the math behind it. So everything looks more attractive in an environment where interest rates come off a bit. And coming off 100 basis points or 1% in a little over a month, not a small move. Other developments in the bond market right here, shown in black up top. This is high yield versus treasuries. Think of this as the inverse of credit spreads, right? Lower is better for credit spreads, pushing on the lows of their range right now. And you see it here in high yield versus treasuries, pushing on the upper bounds of the range. And we've overlaid it with a chart of the S&P 500 because when the bond market is not worried, or when the bond market sees no signs of stress, or showing no signs of stress, tends to be a good time for stocks, right? So we see these lines move together all the time, okay? At the top in 21, 22, a little downtrend, moving lower in the S&P, moving lower in this high yield treasuries. Then they both build a base, right? And now we are getting confirmation from high yield versus treasuries of the action that we're seeing in the stock market, confirming those new highs. Let's talk a little bit about some leaders and some laggards. JC made a good point today. I really liked it. He said back in August, maybe July, part of the reason why we turned short-term cautious, right, or wanted to be less aggressive, at least through the summer months, or back half of the summer, at least, was because there was overhead supply everywhere. That's the second arrow right here. That's where we were, right? So we were looking at a lot of the best charts, whether it was semiconductors, technology, large cap tech, industrials, home builders. They were all running in to those old highs from 2021 or 2022, depending on the index. And we thought, okay, logical level, give some back, consolidate, correct a bit, digest the gains from earlier in the year. And we'll probably slowly work through that overhead supply. That's exactly what we're seeing. And now the strongest groups, the biggest leaders, are taking out this key level, taking out this resistance zone at the old highs. And a lot of them look just like this: XLK, XLI, SMH, which is the semiconductors. And I just brought along a home builders chart as an example of a group that has reclaimed that, this key resistance zone at those old highs. I think the rest of them all follow, right? We'll probably see industrials follow very soon. Want to see them back above those summer highs. I think semiconductors have a little bit more work to do, but all indications are that they will also follow, make a nice resolution above those old highs. And then what are the laggards doing? Well, not long ago, we were talking about financials at the range lows. This is a month ago. 15% ago. Monster move from XLF off of the October lows. So we are no longer talking about the range lows in something like financials or small caps. We're talking about the range highs. And don't look now, but what a nice base has formed here. We really want to see participation from financials in any bull market, right? And I think we're about to get it. I really think we're about to get it. I think the banks are a buy. Not something I say too often. I like the banks here. I like the banks so much. I really like the banks' interest rates. Again, Talk about that 1% move lower and something like the 10-year really, really takes just huge amount of pressure off of these regional banks or any of these companies that have balance sheet or matching issues, which is really what sparked the banking crisis that's marked up in this chart that was March of this year. Seems like a long time ago now. And guess what? We're back and filling this gap, right? Like these stocks collapsed. Regional banks, community banks really collapsed in March when I guess it was Silvergate went under. We're now back, in that, I'll call it volume pocket, because there wasn't much price memory there because of the way that we just sliced through it. We're now filling that little gap. We're filling that little memory zone. Really good stuff from the banks. And how about this one? This is regional banks versus the S&P 500. Looks a lot like the absolute charts, right? Nice reversal pattern. That's been really in place and forming all year. Been patient, kind of watching these stocks, find a floor, carve out a nice foundation. I think a new uptrend is about to be underway for the banks. Broader, or more broadly speaking, I think financials is now a sector that we want to look to. It's a pond that we want to be fishing in. That makes sense. An environment where participation broadens into more and more groups, and it's no longer just mega cap tech or mega cap growth, right? We would expect more of these value sectors to jump in, join the party. Already seen industrials. I think we're now seeing financials. I think real estate is really waking up, bouncing back in a big way. Don't read the paper. They're just going to scare you about commercial real estate. A lot of these commercial real estate or commercial REITs looking pretty good. I think eventually materials catch some rotation. And expecting rotation into these groups that I'm naming is the same bet as, holding the view that we're in a new bull market. Because if this is a new bull market, a sustained bull market, we have to rotate into those groups. So it's not crazy to think that, these laggards or groups that we've been staying away from much of this year, right? The weakest stocks, weakest sectors, weakest indexes, to start paying a little bit more attention to them and thinking that there's going to be big opportunities from these old laggards is just a bull market thought, right? It's going to be a true bull market. And, this thing keeps going. We're in, say, third, fourth inning here. Still have brand new bases or reversal patterns completing right now. Best ones completed Q1, Q2 of this year. But now the weaker groups are completing bases. If you think it's a new bull market, you have to anticipate and expect rotation into these groups. And that means we should be looking and getting ready and looking for opportunities in these groups. So that's all we're doing. Some of these relative trends, I think, illustrate this dynamic that we're discussing pretty well. Whether it's small caps versus large caps shown up top, whether it's equal weight versus cap weight shown in the middle, industrials versus tech, which is just another way of saying value versus growth. I think even international versus US falls into the same conversation. These lines, these ratios start moving up and to the right in an environment where the biggest, best tech stocks are not the best performers. These lines move up and to the right in an environment where market internals are improving and breadth is expanding. I think we're heading there. Do need to see more evidence, right? This is, these are very, these are some serious downtrends, right? So reversing them isn't going to happen overnight. I think we're starting to see the very, very early stages of reversals in these ratios, reversals in these relationships that will usher in an environment where more and more stocks are working, more and more groups and industries are participating, right? Breadth is expanding and the bull market's raging on, and we have opportunities all over the place. We don't just have to focus on the NVIDIAs and the Microsofts and the Apples of the world. So I'm excited about it. Feel like you guys probably are too. Wow. Chat's going crazy. I'm telling the other guys, Curtis, we're trying to get everybody. See, this is fun for me, right? To kind of, we sit up here, we do these videos, and we just talk all day. You want to talk to other people, though, right? I want to hear what you guys are thinking of, what you guys want to talk about. So we are encouraging the other guys to kind of do the same. It does make the videos longer. Definitely makes the videos longer. I also know, little PSA. I owe some of you guys emails. Hoping to get through them today. So thanks for being patient. Get a lot of emails these days, and it does take me a while sometime to get through them. But I see them, and I will get back to you. And if I don't, there's nothing wrong with sending another one, giving me a little push. I always appreciate that. So, but I always do strive to answer all you guys' emails. Can you remind me why you're bullish on Shopify long term? Shopify is really one of very few alternatives to Amazon, right? They do a lot of what would it be, like direct to consumer stuff, where you couldn't do that on Amazon if you're an entrepreneur or you're making, I don't know, some sort of trinkets that you want to sell online. Shopify gives you a platform to kind of do that and have your own little like online shop. Amazon doesn't allow that. So in that way, they offer a very different service from Amazon. A lot of people talk about Shopify and they say, oh yeah, but Amazon. No. It's a little bit different. So I think Shopify literally like owns that market. I don't think Amazon wants to be in that market. And there's just, I think, a very, very bright future. If you look at a stock like Shopify, I mean, this was a very exciting name that got thrown around these secular growth conversations, right? Megatrend conversations, and got a little bit expensive there, 2020, 2021, and then got absolutely destroyed. I don't know, go check what the drawdown was from the highs a few years ago, probably more than 80%. I'll do it right now. Check it real quick. But I just think, it was a generational buying opportunity for a lot of these really special growth stocks. So Shopify, from late 2021 to, October of last year, fell 85%. If, God forbid, we ever go back to those old all-time highs, 130% from here. So not bad. I think still plenty of room to run. And I think that's another point that's worth mentioning with some of these reversal patterns, some of these, beautiful rounding bottoms that are resolving higher. I think taking profits before we get back to those old highs, I think we're really selling ourselves short, right? I don't want to see the Fibonacci retracements on the charts anymore. I don't want to see price target 1, price target 2. No, I think it's really time to press the gas. And we want those old highs. So something like Shopify, more than 100% to go. I really like that. I think there's just significant potential there with this stock. And I like it technically too, obviously. What is your technical analysis on BABA? Yeah, it's not ready. That's a cute one, right? High risk, high reward kind of trade. There are very select handful of stocks in China that are working. I would focus on those. I am getting very interested in China. I think we're at washout levels. I think the Moody's downgrade yesterday of their government debt is very interesting to come this late. I mean, there's no secret that there have been real problems in China for years now. Now they're going to come out and hit them with a negative outlook on their credit. It's a little bit late, kind of stuff you see at bottoms. So I do think China eventually kind of joins in here, starts trending higher with everything else, but just not really seeing it yet, at least not at the index level. Only by, yeah, right. We're going to talk about banks. We're going to get to it. Okay. And Etsy. Yeah. So moving on now to the setups. Rhythm Pharmaceuticals. We had some fellas talking about the Baker Bros in the morning show chat today. So I said, I got to bring a Baker Bros. And lo and behold, look at this one. This chart's perfect. It's so ready. Monster base, 5-year base here. 3750 is that level. Buy this breakout all day. This is a buy on strength kind of setup. Maybe it takes a little bit more time here. We have 1, 2, 3 touches of this level. Might need to, really digest or work through this overhead supply. So be patient. But if and when we're above those old highs, 3750, first target 5880. After that, call it 93. I really need my glasses. So I hope I'm reading these numbers right. But yeah, Baker Bros got into this one around this time last year. Big position too. I think they own over 10%. Costco, just what a business, right? I love this company. Love Costco. Zoom out. That's your homework. Zoom all the way out on a Costco chart. Really good stuff. They also pay a little, think about a market average dividend. 610. 610 gets us back above those old highs after some really nice basing. 610, buy on strength, target 736. This Mark Wayne Mullen came out, filed one of these political filings disclosing some of the stocks that he bought. Was in October, I believe. Yeah, October 12th. Good time to be buying stocks. Good time to be buying stocks. And he bought a couple of good ones. Here's another one. This is from the same filing, almost 2 months ago. This is Sherwin-Williams. Very familiar with Sherwin-Williams. I've been there a lot the past few weeks. Hope everybody likes the new color in the office. A lot of painting. A lot of painting at my house these days. Very, very eager for the painting to be done and to have my house back. Just about there. But look, Sherwin-Williams, one of the largest materials companies in the United States. Beautiful base. You see the transition of trend here, or the stages of trend here, from down to sideways. I think we're going up next. You see this 200-day moving average from lower to sideways, curling higher now. Right, so the level's 283, 354. Long above 283, we're there now. Target 354. This is a big company, probably be a little bit of a slow mover. But I think these are the groups that we really want to be thinking more and more about and finding the best charts, the best setups in these groups, right? Materials, industrials, financials. This is good. Home builders, we've been involved. Love this one. When you zoom all the way out, this is Toll Brothers. Monster base, 161.8 target hit. Get long, stay long. 87. Next stop, 132.50. And if anybody wanted to trade this one, which I did, this chart just looked way too good, right? So now we're zooming way in on Toll Brothers. I bought some calls last week in this one. Tried to convince the analyst team to make this the options trade. Very short term, probably more tactical than we like to be. But listen, bull markets are fun. You can get creative in bull markets. Things are working. You could take some chances that you maybe shouldn't take in a bear market or a range-bound market. That's what we always say. The parties are better in bull markets. The trades are better, more strategies. Something like Toll Brother taking out the upper bounds of this range and then just so high and tight, coiling right above the base breakout level here. I mean, this one was just dying to resolve higher. Little bull flag. And we're seeing it resolve higher now here today on the heels of earnings, I believe. Oh, yeah. Actually, really nice beat. Really nice beat. I just looked at the headline numbers, but really nice top line beat. Always love to see that. They're building homes. People are still buying homes. Real estate seems okay. Even commercial real estate. So if you wanted to take this one for shorter term kind of trade here, 86, target 103. Target 103, that's a measured move, just measuring out what they call a flagpole here. Right? So you take the lows before this automatic advance here. Off the October lows, you take the low, the high, that's the flagpole. Say, okay, once we get a resolution, we tack that flagpole length back on top. That's how we get a target. NRG Energy, this is another new one. NRG. Now, it's not oil and gas. It's not that energy. This is actually a utility. I think it's electrical gas utility. Nice base, though. These are some of my favorite patterns. You got to zoom all the way back out to the pre-financial crisis highs. The market remembers those highs. right? Keeps tapping on them past few years here. I think we're just about ready to break through. In fact, I think we're breaking through today. Let's see, NRG. Our entry level is about 47. Yeah, looking good. Not really doing anything today. This chart looks excellent. So if we're above 47 and you want to add some utilities exposure to your portfolio, I think this is an excellent option for that. 47, long, target 70. We also have 108 here, but just know you're buying a utility stock. It's going to should move a good deal slower than other stuff, right? Lower beta. And that's okay. CEO and director, Form 4 filers, actually 6 different insiders in this one about a year ago. So the insiders like it, the technicians like it, people who like dividends probably like it. I'm sure they pay one. So long above 47. Next, wants to talk about some crypto. Okay. I'm going to tell a little story. Silvergate Bank, Signature Bank. Has anybody heard of these? Ticker symbol SI and SBNY. If you're following along at home, you might not be able to pull the data for them anymore because they're gone. Gone. Bankrupt. You could say they collapsed during the banking crisis. Other people who have better information might tell you that they were shut down by the government. Either way, they don't exist anymore. Those were the strongest banks, far and away the best banks that you could have owned during the last bull cycle, 21 and 2020. These stocks were so hot. They looked like cryptocurrencies because they were doing something very different than most banks. They were banking crypto. Most banks do not bank crypto, right? You could count on one hand how many do it. So when those guys disappeared back in March, April, whenever it was, Customers Bank Corp, also a crypto bank, got all those deposits. All new customers for Customers Bank Corp, very appropriately named, right? So ticker symbol QB. This one has tripled off of the May lows. Looks a lot better than most banks. Looks a lot better than really any bank, I think. So I guess the point I'm trying to make is we've seen this movie before where these crypto banks are just very clear leaders. And, in the case of a Silvergate or a Signature Bank, I mean, straight up way faster than everything else, and then straight down way faster than anything else. Does this happen again? Does history repeat itself? I don't think it necessarily needs to. Maybe Customers Bank Corp really paid attention to what happened earlier this year. Maybe it learned from Silvergate and Signature of what not to do, how to be on the regulator's good side. I don't know, but this one's interesting, and the leadership really stands out. And if you want to take a shot, I don't hate it. This is a crypto stock, and those are some of the best stocks in this market. We're above 50. I like it. I like it. You could own it all day. 50, target 76, so more than 50%. Nice. Bay Pond Partners, 13G filer. And then let's just illustrate that leadership a little bit. This is QB versus regional banks. You can see the beautiful base, beautiful reversal pattern here, but I'm more interested in the lower pane. This is QB versus its regional banking peers. New all-time highs, coiling, high and tight. Just looks great from a relative strength perspective. Now let's talk about crypto. So I've zoomed way out on this chart of Ethereum. You guys see what I did here? What do you think? Am I crazy? Because all I did, I said, oh boy, we had a reversal pattern, a lot like the one we have today. We had one back in 2020 that kicked off the new bull market. And then Ethereum went on to rally over 1,000%. Like a year. So if you were to use history as, a guide for maybe where we go in the future, well, let's measure this from the base breakout level. Let's tack on 1,000%. Ethereum 26,000, about 10x higher from where it is today. Again, I'm not coming on here and saying my price target for Ethereum is 26,000. I'm not saying that. What I am saying is it's very possible and not crazy at all. And if that were someone's price target, shouldn't laugh at it. I think Ethereum well over 10,000, Bitcoin over 100,000, right? The reversals are in. So it's more for illustrative purposes, but understand the profit potential when these assets are in bull markets. We're seeing so many reversal patterns, so many just clean base breakouts in the altcoins, right? Ethereum, really nice, really clean chart. Just got the breakout last week, this weekend. Here's Avalanche. This is one of my favorite, very long, really clean base breakout. The animal spirits are alive and well. Talking about breadth expansion, right? Or a bullish improvement in participation. We're not just seeing it in the stock market, we're seeing it in crypto, right? So it's just so much good stuff going on beneath the surface. I had to bring these two charts here to kind of set the stage for a little conversation on some crypto stocks. Now, MicroStrategy has been one of the best ones, right? The Bitcoin miners were really good earlier this year. Then they were pretty bad for a while. Then they were not really participating as much as something like Coinbase or MicroStrategy. Now they're kind of waking up again. Forget it. We got other options. Less complicated stuff. I don't like the cap tables with those companies either. MicroStrategy looks so good. 500, target 885. We've already hit a couple price targets in this one this year. Speaking of hitting price targets, that's what Coinbase does. I mean, I don't like to pick favorites, but if I had to, it's probably Coinbase. I love this stock. I think 160 is next, but really, we want 380. We want those old highs. Again, it's time to be aggressive. Don't buy this beautiful primary trend reversal and then go sell it, the first little resistance zone. Let them dance. Let these things go. Let them run. I think most of these rounding bottom patterns, these base breakouts, these just clean primary trend reversals, I think if you have a long enough time frame, your target or your objective should be getting back to the old highs. For Coinbase, that's 380. But we have to be patient. So what am I trying to do here? Trying to illustrate that this stock has really never been so extended, ever. Maybe to the downside, right? See that with the red here on the left-hand side of this chart. This is the percentage from the 200-day moving average shown down here. This is the 200-day moving average with the green shade beneath it. We've never been more extended or further away from the long-term mean in Coinbase. Does that mean the stock has to pull back or has to correct? Doesn't have to do anything. Go straight to 380 tomorrow. It's not the bet we want to make. It's just telling you at these levels, if you're entering here, you're making things probably harder than they have to be, right? It's not a great place to enter. It's a place to allow for some digestion or corrective action. And then the uptrend, I'm sure, resumes in time. But after going pretty much straight higher for like a month now, probably not the best place to enter. Be patient with Coinbase. It's a beautiful, beautiful reversal pattern. But you don't want to see things move in a straight line too much. Is I guess the point I was trying to make. Questions, comments, concerns, say hi, shoot me an email, shoot info@allstarcharts.com an email. And let's just check the chat real quick before we get out of here. Oh, energy, I did not forget. Costco, long-term compounder, so good, guys. What broker do you use? I have, guys, I'm not the one to ask. In fact, Rachel was just telling me that I'm probably an idiot and I'm paying too much in fees on Coinbase. I was just talking to the analyst team and I was saying, I don't think, fine, maybe I am overpaying in fees, it sounds like, That's why I'm so lucky I get to come on here and say these things. You guys are smarter than me. Come and tell me, what are you doing, you idiot? You shouldn't be paying 2-3% in fees. I thought that was crazy too. But what I do know is that I'm not going to look back in a year or 2 years when we've sold all of our crypto and made these beautiful gains, right? Great trades, got in right at the early stages of these reversals. I'm not going to look back in 2 years and say, it was the fees. It was the fees that really did that investment in. Sure, you always want to pay as little as possible in fees, but we're talking about something like Ethereum going up 1,000%. I don't think anybody's going to look back and say, these fees, right? It's the last thing you're thinking about. But to answer your question, I have Coinbase, I have Gemini, I have Binance, I even have eToro. Don't ask. We've got friends over there. I have an eToro account. And as much as I'm embarrassed to say, I've made a couple purchases on my Venmo app because it's just so convenient. Sometimes I'm like, you ever just wake up in a cold sweat in the middle of the night and you're like, you got to buy crypto? I was just buying it on Venmo. And I was like, actually, I don't mind this. I kind of like this. I trust PayPal. But really, Coinbase. Coinbase is the brokerage and the exchange of choice when it comes to crypto. I think we opened up a Binance because they got all sorts of crazy stuff on there. I think this time around, this new crypto bull market, which I very much believe that we're entering right here, right now, I think this time around, I will probably do a lot less funny stuff with these alt or shit coins. I don't think I'll buy any NFTs. It's a mistake I made last time. I don't think I'll buy any helium miners. I don't think I'll buy any altcoins or shit coins that are out of the top 100, right? That's pretty much my line. So I'm going to do less. And I think it's the right strategy. I think it's the right move. So real quick, let me hit up, let me hit this energy topic before we get out of here. Energy is not ready. Everything else is working in this market. Energy, it seems like, is down every day. Oxy, it's near that level, the Buffett zone, right? I think that's where the question came from. Right around 57, 58, low 60s. That's where we've seen Buffett come out and buy Occidental time and time and time again. That doesn't mean he's going to be right. I know he's Warren Buffett. I know he's got a lot of money. He's putting a lot of buying power at that support zone. Really, he is the support. Doesn't mean, he's not right every single time. You don't want to see these multi-year consolidations. Oxy is a great example. You don't want to see that turn into a completed top, right? Because then I think the corrective action, or what was just a pretty constructive consolidation in energy, right? Straight line higher off of those 2020 lows, and then just a massive consolidation. You don't want to see that consolidation turn into a top. That would be a trend reversal pattern, and it would indicate more downside, more corrective action, maybe even a new bear market for energy stocks. So they're not ready. We need to see these ranges break out. We need to see crude oil stop falling every day. Gasoline needs to hold its range lows. The explorers and producers need to stop underperforming so terribly. We need all those things to start happening, and there's just no evidence of it yet. So energy, don't throw it out. I have a little bit of exposure to energy still. My long-term accounts, my savings account, my IRA. I'm not going to go selling them, but I'm definitely not adding energy exposure here. I think there will be a time and place where we're pounding the table. We're very excited about energy in the future. It could take a month. It could take a quarter. It could take a year. It could take longer. We just don't know. So we're going to continue to monitor it. But so much other stuff working. So many other markets trending. Stay away from energy. It's range bound. It's messy. There's just not much there. So Oxy, yeah, I think our level is 57.50. Could own it against that, but things are getting dicey in the Oxy here. 56.68 today. I mean, look, you could do this at home. Just go draw a line at those pivot lows, right? We've seen Oxy find a floor here and rebound off this level over and over and over again. What we haven't seen Oxy do, though, is rebound in any meaningful way to go on and hit our price targets. It's one thing to hold support, but let's go hit some objectives. Oxy hasn't done that in a long time. So yes, if you're just itching for some energy exposure, Oxy is buyable at this level. But again, if this turns out to be a complete top, I'm going to be coming on here saying very different things about Oxy and energy in general, because they'll all probably complete at the same time. I love that ETH analysis. Cool. I like it too. CLF, this is Carter. Join us on Chart Request Live tomorrow at 1:00, and we take ticker requests live on that show. It's a blast. Pat and I have such a good time. Thank you for the time, everybody. Thanks for joining me. This was so much fun. As always, see you back here, same time, same place next week. This was the Hot Corner. Thanks, guys.